Ladies and gentlemen, good day and welcome to the Q1 FY25 results conference call of GTPL Hathway hosted by Emkay Global Financial Services. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pulkit Chawla from Emkay Global Financial Services. Thank you, and over to you, sir.
Thank you, Sagar. Good evening, everyone, and welcome to the Q1 FY25 GTPL Hathway earnings call. From the management, we have with us today Mr. Anirudh Singh Jadeja, Promoter and Managing Director, Mr. Piyush Pankaj, Business Head CATV and Chief Strategy Officer, and Mr. Saurabh Banerjee, Chief Financial Officer. Without any further delay, I shall now hand over the call to the management for their opening remarks. Over to you, sir.
Thank you, Pulkit. Good evening, everyone. A warm welcome to everybody to the earnings call of GTPL Hathway to discuss financial performance of Q1 FY25. We continue to see positive transaction in subscriber in both our division, translating to continued growth momentum. We are steadily approaching quoted milestone of 10 million subscribers in the cable TV division, and as we look back our journey over the years to become the largest MSO in the country, we are filled with a sense of determination to carry this forward. Our broadband segment has performed well and post the price hike from major telcos. The option of high-speed unlimited wireline broadband to be shared amongst the family members become even more lucrative for people. I will now hand over to the call to Mr. Piyush Pankaj, who will take you through the KPI and for cable TV and broadband segment.
Thank you, Mr. Jadeja. Good evening, everyone. First, let me share the usual KPIs for our cable TV and broadband business before delving into some of the recent tech solutions and collaborations implemented in this quarter. Our digital cable TV subscriber base as on 30th June 2024 stands at 9.6 million. Paying subscribers stand at 8.9 million. On a YOY basis, the increase in active and paying subscriber is 550K, a 6% increase, and 600K, a 7% increase respectively. In the broadband business, active subscribers as at end of the quarter stood at 1.03 million. We thus have added 70K new subscribers, which is an increase of 7% on a YOY basis. Home pass stood at 5.90 million as on 30th June 2024, of which 75% are available for FTTX conversion. Home pass grew by 500K on a YOY basis. The broadband ARPU for Q1 FY25 remained stable at Rs 460. The average data consumption per customer per month stood at 350 GB and 13% increase YOY. I would now like to take a moment to go through the various tech implementation we have undertaken to address and enhance certain operational facets and improve the overall customer viewing experience. The first one is the Jiva, which is the GTPL interactive app. The deployment of MLP-trained AI chatbot integrated with WhatsApp to enable full customer service automation, offering round-the-clock support. It is equipped with payment features to further improve our digital collection. The second one is the Genie ATM, which is the implementation of Genie Network's network performance solution to analyze and optimize traffic. Genie ATM will help provide valuable and real-time insights that will enable us to undertake efforts towards elevating the performance and increase efficiency of overall network and all resources involved. Providing reliable and secure services become paramount as company is constantly expanding its subscriber base, footprint and portfolio of offers. The third one is TV Key Cloud. We collaborated with Samsung and Nagra for the launch of industry's first product, namely the TV Key Cloud. It allows users to access linear TV content on their connected TVs without the need for additional wires or even a set-top box. This results in cost savings for the consumers while allowing them to enjoy both normal TV content as well as OTT apps. We have rolled out this product pan-India, and it presents a new opportunity for us to garner new subscribers from whom we will be the default live TV source application. As evidenced by our KPIs, we have seen a constant trend of rising data consumption with sustained additions to both our cable TV and broadband subscriber base. Our capex in strengthening our infrastructure as well as expanding into new territories have been translating to consistent net additions in our subscribers at a time when the overall industry has seen elevated churn post-COVID. Offering new products, competitive pricing, and leveraging technology will drive our business forward. I will now hand over the call to Mr. Saurabh Banerjee, who will take you through the financial performance of the company.
Thank you, Mr. Piyush. Good evening to all the participants. On a consolidated quarterly financial results, total revenue grew by 9% YOY to rupees 8,506 million. Subscription revenue saw an increase of 7% YOY to rupees 3,193 million. The broadband revenue stood at rupees 1,348 million and registered a growth of 4% on a yearly basis. Consolidated EBITDA stood at rupees 1,205 million with an EBITDA margin of 14.2%. Net profit for Q1 FY25 stood at rupees 150 million. Now on to the standalone results. Total revenue grew by 6% YOY to rupees 5,433 million. Subscription revenue saw an increase of 3% YOY to rupees 2,249 million. Standalone EBITDA stood at rupees 690 million, stable YOY with an EBITDA margin of 13%. Net profits for Q1 FY25 stood at 150 million. With regard to other updates, the credit rating agency India Ratings and Research has reaffirmed the company ratings and its debt facilities at IND AA- stable. The rating affirms the healthy financial position and strong balance sheet driven by prudent debt management and a free cash flow generating history. I would now request the moderator to open the floor for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devang Mehra from SKV Capital. Please go ahead.
Hello, sir. Good afternoon. Sir, my question is to the CFO, sir. So on the interest cost end, can you share the reason why our finance cost has increased sharply? Are there any credit lines we are drawing? Also, what the debt repayment timeline? I think in the previous call, management has guided that we will see the debt at FY23 levels. Are we on track for that?
Yeah, thanks for your question. The interest cost has risen to a certain extent because of greater utilization of limits over a period of time. And also, we have the LC facilities, the BGs that we have taken for various business reasons. The cost of those LCs and BGs also get added and reflect in the interest cost. That is one of the reasons for an increase. The other is a purely accounting matter, wherein the finance cost or interest cost also includes the operating lease cost. So as per the Ind AS 116, it has to be accounted as part of the finance cost. So almost close to 2 crores of that portion, which is more of an accounting treatment as per the Ind AS 116 requirement, is also included in the finance cost. As far as the overall borrowings are concerned, you would have already seen that there is a decrease in the overall borrowing by almost 4.55 crores, particularly because some of the long-term borrowings have been repaid. So that's the reason why the borrowings have started coming down. Going forward during the year, the company will make an endeavor to ensure that borrowings stay within a reasonable level and there is no increase in the debt amounts. Thank you.
Okay, sir, got it. And so second question is on depreciation side. So you guided that the capex is necessary to maintain the subscriber base, and we understand that what is the level we should expect depreciation to settle at. Since typically what I have noticed is that depreciation is lowest for you in the first quarter, but given it so elevated currently in the first quarter itself. So we expect higher than last year depreciation. So any guidance on the same would be very helpful.
Yeah. So if you see from quarter 4 to quarter 1, almost the depreciation is almost same, from 90 crores to 91 crores. It is showing there. And as you know that we are spending around 350 to 400 crores of capex in a year. And if I talk about 8 years to 9 years of the depreciation on that, so every year we are looking forward that around 30 to 35 crores will added into the depreciation. But yes, the block will go away also from the below. So we are looking forward that somewhere around between 25 to 30 crores, which is going to be added in the depreciation for next 2 years, and after that it will start coming down.
Okay, sir, got it. Thank you. That's from my side.
Yeah.
Thank you. The next question is from the line of Vinit Manek from Karma Capital.
Good evening, sir. Thank you for giving me the opportunity.
Yeah.
This question is for you, Jadeja, sir. Sir, if we look at like more than 10 quarters now for us, our top line growth has been really soft and it is getting more softer going forward also. But on that, if we see our other expenses have significantly shoot up from almost like a run rate of 120, 140 crores to now upwards of 200 crores. So structurally now as an investors, how should we look at the business going forward? Because our top line growth is not happening, and despite of that, our incremental spends are really higher, which is leading to a negative operating leverage to our business. So how should we look at that going forward?
Yeah, Vinit, first I will attempt this, then I will request Mr. Jadeja to come into that also. See, yes, you're right that the operating expense is going up, but there are variable cost and the fixed cost. The variable cost has to go along with the revenues, which you have seen that we have gone up in the revenues also. So those variable costs is already getting up on that basis. Yeah, some of the fixed costs on, at least for this quarter, I can say that in the anticipation of expansion of new business in cable TV, the company has made the infrastructure and taken the bandwidth from last 2 quarters. But due to the elections and second is the anticipation of price increases by the broadcasters and what is going into the industry, we have just added 100K in the last, you can say last 1 quarter or last 2 quarters, you can say somewhere around 150 to 160K, which was a bit less. Yes, we are taking the corrective actions. So wherever the expansion will not be possible, we'll prune down the cost. That is on the cable TV side. Yeah, broadband side, business side, it is more of the variable cost which is there because as you know, we have started the B2B vertical and there the commission cost, which is up around 50 to 60% of the revenue, has to go into the operating cost. And this quarter we have added around 30K of the net of the gross additions in the B2B and net additions of around 7K. So those costs have come into play there. And in the current quarter, there is a PFTD of around 3 crores of somewhere close to that, which is we have taken the that's outstanding of one of the broadcasters, which we have provided for conservative accounting.
Yeah, it's a whole broadcasters. अभी तो उनका broadcasting भी switch off कर दिया, but it's a whole due, so उसको PFC वापस.
Still, we are in constant touch with them, and hopefully they are committed that they will pay us. So, but for conservative accounting, we have taken. So you are seeing that the increase in the operating cost because of these three reasons right now. Yes, you're right that of the cost has gone up in the anticipation of creating more business. As you are more in the expansion mode, at that point of time, you have to create the infrastructures and all in our business in advance, and that's what we did. But yes, we will see that wherever we can cut the infrastructure, where the expansion is not possible or expansion is not as per the expectation, then we'll do that in the coming quarters.
But on the growth capex also, we are not able to see a commensurate growth, because as we see that there is no great pricing action on both our businesses, except the new implementation of the NTO. So we are also not able to get the volume growth on the part of the subscriber addition, and also as specifically you mentioned about the broadband business, that there is a huge scope, but our broadband business subscriber addition has been incrementally slowing down. Our growth over there has been now mid-single digit kind of a growth on the top line. So despite of all the efforts done on the operating expenses side, we are not able to grow the business. So it is not even the growth happening, and we are losing on the profitability side also. So that is the reason this question comes up.
So I will take one by one. The first on the cable business, Vinit. Cable business, as you know, we are doing around 500,000 in the YOY basis. Yes, the opportunities are more, but we have to put more CapEx. As you know, I have already given that part of our CapEx is going on the maintaining of the business, being in the flux of that business. But yes, we are seeing the reverse trend now, as you can say that we are seeing that that churn is going down year by year, and we are hopeful that the churn will go down with the time, as the euphoria created after the COVID or at the period of COVID and after the COVID, that is already getting arrested for the, and there we will see that our increment will be higher. As you know, we have entered into new 4 states in the last 1 year, and the scope is very high on those states. So we are hopeful that in the cable TV, we will start seeing the target, which was earlier around 800K to 1 million in a year, that we will start jumping towards that. So yes, that is the case. In the broadband business, yes, last 2 quarters are a bit muted. The reason is that the new technology, which is V-Fiber and the Air Fiber, has come and created some euphoria in the market. Now it is again coming back. That euphoria is dying, seeing that what is happening. And again, we are hopeful, which June month has shown some thing that again the FTTH is coming back into the market, the pure FTTH, and which is more consistent and reliable. Plus the increase in the prices by the cellular operators, and that will help in the wired business again, because the data cost is increasing there. So we are hopeful that we'll come back again to that, adding around 80 to 100K subscriber base in the broadband. So that is there. We are hopeful in the both the business. Both the business has a lot of potential, but yes, it is seasonal, you can say, because going up and down. If some event happens that some quarter goes up, some quarter goes down. But yeah, that is the case.
Okay, and just one last question from my side on the specifically talking on the margins. So few quarters back, even on the television, you guys have guided for a 20% kind of EBITDA margin, including your other income. So we have been like off the mark on that since many quarters, and the gap is increasing. So when do you expect to reach there, or do you expect the margins to be lower, and how should we look at that from an FY25 perspective?
Yeah, Vinit, I will say that that's why I started giving the operating EBITDA in my presentation, investor presentation. Because as I explained that for looking at the business perspective, that how the business is performing, we should go for the operating EBITDA rather than this EBITDA, where the problem is that, which I explaining again, that the marketing and marketing placement and the revenues, the contribution of that to EBITDA is between 2% to 20%. So depending upon what type of deals are happening with the broadcasters and all. And that's why it is very erratic. And that's why I always say that we have to see, because it is going to the same broadcaster, that we have to net the cost from the pay channel minus the marketing and revenue, and see the operational EBITDA. So in the operational EBITDA, yes, you will see that last year we did 24%, and the first quarter is at 23% right now. That's why, because I have explained that some of the costs which we have taken extra cost, the PFDD and all, but we are very, very sure that it will come back to 24 to 25% in the whole year, and we will maintain that 24 to 25% of operating EBITDA, which is there prevailing from the years.
So that should come in the coming quarters, because I think as I collate some past numbers from FY22, FY23, we were about 28% kind of a 28 to 29% operating.
Yeah, those Vinit, you have to see more consistency on 19, 20, 21, 22 was a great year for the broadband, as you know. We were adding around 150, we have added around 160, 180K also on those years, those time, because of those euphoria. Euphoria is for the broadband also, for the OTT also, everything, which is now more on the stable side, which I have always saying that we'll do stable in 80 to 100K or maximum 120K. But that time it was 180K, and that's why the margin has gone up to 28%, 27, 28%. But before that also, you will see we are at 24, 25, 26%.
Okay,
that is the consistency, that around 25% is what it should be.
Okay. Thank you for your detailed answers.
Thanks.
Thank you. The next question is from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hello. Good evening, sir. Thank you so much for taking my question. So I'm a bit new to the company, so could you, if possible, just briefly explain the difference in the margins of 13% reported and 23% in our this?
Yeah. I'll explain. Because what happens that we have two relations with the broadcasters. One relation is the pay channel cost, and second is the marketing and placement. Marketing and placement is also related to those services only, but it is billed on a different invoices. So we have to book it as a revenue, and here it is a cost. But both are, for the broadcaster also and for us also, both are related. So what's happening that depending upon the deal, somewhere the marketing and incentive is giving 20% margin, somewhere it is giving 10%, or some broadcaster it is giving just 5%. On the margin side, if I talk about. So whenever you have to see the real business, you have to take out those costs. So pay channel, so from the revenue, you take out the marketing and those revenue, and then you reduce in the cost, the pay channel minus marketing and all, and then you have to see their margins. And also take out some of the one-time revenues, that is activation revenue and one-time other incomes, which is like one time. And then you see. So if you go through my presentation just after the P&L, we are giving the operating EBITDA margins. which you will see that for this quarter we are at 23%. Last year, full year, we were at 24%.
Oh,
That will
okay.
give a better insight in the business performance.
Yeah, fair enough, sir. Understood, sir. So the margins are that way. But so in terms of our revenue top line growth, what could of guidance could we give for, maybe FY25 and FY26?
No, the growth will be on the same range which we are doing right now. Yeah, subscription you can talk about. Yeah, subscription is going to be somewhere. We are trying to have a double digit. If you see Y to Y, we have at around 7%, but FY to FY, we are going to be in the double digit number.
So for same way, I think we did 20% in FY24, so something like that is what we can hope for, sir, right?
Yeah, if you're talking about the total revenue, yes, that is going to happen, surely. And if you're talking about the subscription revenue, it's going to be in the double digit.
Okay. Fair enough, sir. And sir, are you planning to take any price hike in any of the business in the, broadband or this? Are we planning for any price hikes?
Yes, we are going to do in some of the strategic market, mainly in the cable side, not in the broadband side. Cable side, yes, we are thinking of doing it in some of the strategic market, but yes, we are waiting for that. Now the election is over, everything is over, so we will do it somewhere in the quarter two.
Okay, fair enough, sir. Yeah, that's it from my side, sir. All the best, sir. Thank you.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of GTPL Hathway from Robo Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. Most of my questions have been answered. Can you just highlight a few trigger points for a revenue growth and margin improvement? And by which quarter can we see this 26% margin coming in?
The trigger point is more of as you go for the ARPU increase in the business, that will straightway going to hit it in your margin. When you are doing the volume increase, there is cost which is going to build up. Some of the cost, plus there is going to be capex support. If you are just going for the value increase, which is more of the ARPU increase, that will straightway come into the margin. So here, as I said, that in some of the strategic market, we are going to take and do the ARPU increase as some of the market is getting matured now. As you enter into new market, you have to do it at the lower prices, but as you get matured in those markets, you tend to increase the ARPUs. So that's what we are going to do in the most probably in this quarter too. And so that's where we are looking forward that it will go. Plus, as I said, that some of the cost which is built up is more of like a one-time cost, or we have to prune down. That will bring down, which will bring up the margin, a bit of margin again. So that's the two factors which we are looking forward.
Okay, got it. That answers my question. Thank you so much.
Thank you. The next question is from the line of Sahil Vora from M&S Associates. Please go ahead.
Hello, sir. Am I audible?
Yes, Sahil. Please, go ahead.
Hi. Firstly, thank you for the opportunity. My first question is on the TV Key Cloud product. Could you highlight how exactly the product functions? And I think in the press release you have mentioned that it will make GTPL the default live TV application.
Yes.
Source application. So will they be using our cable TV services or how does it all work exactly?
Yeah, so it's more of that you can watch GTPL straight into the Samsung TV and by plugging the wire into the TV, which was like in the old times, if you remember, that there is a tuner built in the TV. Every TV has that, and you used to put the wire straight with there without the set-top boxes or any boxes up there. The same thing you have to do without the set-top box. all conditional access systems and all those things will be through cloud, which is already inbuilt there in the Samsung. And there is a live TV option embedded is going to be embedded